So the presentation again, income investing, the power of dividends. We're going to cover dividend stocks, how to locate them, how to search for the highest quality stocks in that group, and how to kind of build a portfolio and show you how it can expand your profitability from these stocks. So the easiest tool to use for this, and I didn't prepare slides, I thought this would be better to do live. We have something called the AllinOne Screener on the website, and what this will do is allow you to scan through stocks meeting any number of fundamental criteria. So to locate this, top of the screen, hover over the screeners window right here, and the first option is going to be all-in-one Guru Screener. And you can see that right there at the top. We'll select that, and it's got a bunch of different tabs on it that can let you search for various things. So if you're looking for, fundamental data, profitability ratios, growth, etc., etc. But we're going to focus right here on the dividends tab for right now to show you how we can isolate stocks, meaning a select group of criteria. Now, the dividend portion is pretty lean. There's not a lot of data regarding dividends. There's what's the yield, what's the expected yield on cost. The dividend growth rate is a 5-year growth rate. The minimum number of years they've paid dividends, and then the payout ratio. And this is simply the percentage of the company's net income they're using to pay for dividends. And a lot of people ignore this. They just look for high yields. But the thing is, if a company's spending 80-90% of what it makes just to cover dividends, what happens when they have a lean year? What happens when they have a poor earnings number? Well, they're going to cut their dividends. The money's not there. A company, on the other hand, that only pays out 20 or 25% of its revenue in dividends still produces a decent yield. They've got a lot more flexibility, and they'd have to see their sales cut severely before they didn't have the cash flow to pay those dividends to investors. So what I like to do on this is start on the fundamental tab. First, just want to make sure you get a decent quality stocks. So we're going to go ahead and I'm going to select USA stocks here to kind of focus on just the United States for a country. I'm going to look for market caps of $1 billion and larger. It's going to give us kind of large, small caps or mid cap type companies. And again, these have two drop downs. So the left side's the minimum, the right side's the max. That's how that works. And this says OTC stocks. It's over the counter. I go ahead and exclude those. They're just not as strictly enforced. Their filing requirements are leaner. It's just there's not really conclusive data on them as a whole. Okay, and then all we're focusing on is going to be the dividend, the history of these dividends, what we can expect going forward. Because as a dividend investor, the ideal situation is this. It's not I'm going to buy the stock at 30 and we got to 37, I'm going to sell it. The idea is that you never care about the price of that stock for the rest of your life. That's the hope. The hope is that you build up enough of these dividend stocks until the dividends are giving you checks of $5,000, $10,000, $20,000 a month, whatever that is for you, and you really don't care whether the stock is trading for $1 or $100. All you want is to see your paychecks keep coming and keep growing, and then ideally this will be a huge asset that you can pass on to family or relatives or a charitable trust or whatever that may be, and your principal all remains intact, whether it's $1 million, $10 million, $20,000, whatever that may be. Okay, so just remember that as we present this, because you're trying to separate yourself from the price of the stock and focus on the yield and the cash flow, right? Just think of it like a rental property. I mean, yes, one day you could sell it, but the hope is you just collect those rent checks, pay off the house, and pass the home down to someone else and maintain that asset. So you really want to focus on not deteriorating the assets. I mean, if you guys read Rich Dad, Poor Dad, he kind of defines assets versus liabilities. And an asset is something that produces cash flow, as such as a dividend. A liability is something that costs you money. So a home, your car, people that think are assets, in a different way of looking, actually cost you money as far as repairs and taxes and other expenses. And so just try to switch your mind to that side of it, okay? So what we can do now, we've got some basic companies. We'll go to the dividend route. What I generally look for, today's average yield of the S&P 500 is about 2%. All right. Now, it seems strange to think like this, but focus more on the quality and growth of the dividends versus the yields. In other words, I would rather have a 2% yield from a quality company that increases their dividend each year versus a 4% dividend from one that is not as safe. Because here's the thing. If they're growing their dividends, say you've got one company growing, say it's yielding 2%, but their dividend increases 10% a year, and then you've got another one that pays maybe a 4%, but they only increase maybe 1% a year. If you're holding these for a long period of time, stock A is soon going to yield you a much greater return than stock B because this payment is increasing by just 10 times what the other is. Okay, and if this one's kind of shaky and one year they pay no dividend, then they shrink their dividend, it's just not worth it. And if you're looking at a 10, 15, 20, 30-year time horizon, this is really where you want your money to be. That's really where the safety is. Okay, so for the dividend yield, I'm going to set our minimum at about 2%. That's the average for the S&P right now. Some of the highest quality companies, their yield is low because the price is high. Does that make sense? I mean, if they paid $1 a share at $50 at a $50 price, it's 2%. But when the price rises, that yield lowers. So look at 2% or greater. With the payout ratio, as I mentioned, we don't want a payout ratio that's too high because it just says that the company, should they get into financial trouble, is not going to have the cash, and that's when they're going to shrink or delay or just take their dividend off the table for a while. So as a rule of thumb, the max we want to do here is about 60%, and that's what we set it at. You can go a little bit higher or a little bit lower, but you want to stay really within that range. And then the dividend growth rate is additionally important, right? We don't care if it's a 4%, 5%, 6% yield today if it's not going to increase going forward, right? We want our yield on cost to be very high one day, and I'll show you in a minute what that means. So I look for a minimum of a 10% average dividend growth rate. Okay, so they pay you $1 one year, they pay you $1.10, $1.21, $1.30, etc., etc. And then for minimum years of dividend payment, this is going to be up to you. I would suggest going either 5 or 10. I like to go 10 years just to put absolute safety to it. If you want to go 5, you'll get a bit of a larger list, but it's a little bit more risky because they don't have quite as long of a track record there. There are exceptions on a case-by-case basis. So to give you an example, Apple just started paying a dividend. And if we look at Apple, we'll kind of get some specs on this stock and what their yield is. Now, they just pushed $600 a share today. So they're yielding about 2%, right? About in line with the S&P 500. But their payout ratio is very low. I mean, it's only taking 22% of net income to cover that. It's not showing growth because they just started paying it. And they haven't begun buying shares back. But this is a company that's sitting on, what is it, $100 billion in cash overseas. I mean, they're just massive, massive amounts of money. They just generate tons of cash flow. They have very low expenses. So this is one, I wouldn't worry about from a financial health point of view. And if we go to the summary tab here, I mean, we could see that financial strength is very strong, profitability and growth is very strong. It's just not a company you see going off the map tomorrow. But if you're looking for a basket of stocks, it's the easiest way to do it. Okay, so that'll give us a big list, and here we just want to drill it down. So is everyone following me so far? Let me know if I'm losing you. I apologize. If I'm going too fast, you need me to repeat something, just say. But I'll show you kind of what I'm going to do is slowly build together like a 10 stock portfolio for you guys. Everything good? Okay. So what I like to do here, you can actually export this data, one of the many features of GuruFocus, and right here is a download button. And anytime you run a screener, not just dividend stocks, anytime you get a list of stocks like this, you can click that download button and just export it into an Excel document with all the data. All right, now I did that before this webinar, so we'd have to go through the whole process with you guys, and I'll show you kind of what we started with. And this is that same list. I got about 68 stocks here, and I cleaned up some of the data. I mean, it gives you tons of data when you do a big export like that, but just highlighted the things I thought would be important so we could kind of analyze this a little bit further. So we've got the ticker symbol, the name of the company, price, what it's yielding now, payout ratio. And again, all these are meeting our specs from earlier. Growth rate, sector, et cetera, down the line, right? So here's how I would begin to trim this up. And you can do it with the filter. I just did it this way because I thought it would demonstrate this a little bit easier for you. The first thing I did was sort the stocks by predictability. And GuruFocus has this predictability ranking that I'm sure a lot of you guys have seen. And it's right up here top left of any stock. And what it does, an algorithm Charlie built that analyzes the company's revenue and gross profit over the last, I think, 7 years, and scores it based on how predictable those cash flows are. And you can kind of see this in chart format. To give you an example, and this is a 4.5 star, really, really highly predictable company, and this is why. Let me just show you what this looks like. So here's their revenue stream. Okay, and you can just see nice smooth growth here over the last couple of, at least last decade. Then EBITDA is very smooth as well. So the chart on the right is quarterly, chart on the left is annual. It's a little bit smoother on the left, but an unpredictable company is going to look more kind of like this. They may have a losing year and they're up, but what you want is something nice and consistent. And that way you don't have big surprises. They don't surprise you with a big loss one year. They don't blow past numbers and then come back with them. And there's lots of studies. Charlie's done one that analyzes the predictability of a company versus its performance, and he's proven beyond a shadow of a doubt that these higher predictability companies not only offer lower risk but also outperform a basket of stocks by wide margins. So anyway, I sorted them by predictability, and I went ahead and deleted the ones that were one. So I went predictability of 2 stars or higher just to begin trimming our list. Okay, so it took about 20 or so of the names off. A 1-star predictability means they've had a losing year sometime in the last 10 years. And this is our money. We're looking for cash flow. We don't want any surprises. So we're getting the most predictable companies. That trims us down from 68 to 43. All right, everybody follow me so far? I just sorted by predictability and then just deleted these down here. And you can do the same thing in the screener if you want. If you want to just come in here and select your predictability, to 2 or higher, you can do that. Yeah, Susan, we can add that. And I'll do it kind of simultaneously here. If we do predictability 2 stars or higher, that's going to do about the same thing. And something may be different here. Let me see what I changed. Yeah, okay. All right, so that kind of trimmed us down a little bit further. And then next, I was looking at the share buyback rate. And there's no perfect order to do this. I'm just kind of using some common sense on what's going to add the most value for us. Okay? Now, you all understand how share buybacks work and how they're positive for shareholders. If not, I'll teach you in 30 seconds. I'm assuming most of you understand this. If you don't, let me know, and we'll cover it really briefly. Yeah, you got it. Okay. If anyone doesn't, just let me know. So we filtered by share buybacks. We want the highest buyback rate possible. Okay, because that's powerful for us. It increases earnings, it increases the share price, it increases our dividends. And so I filtered it down to the ones whose buyback rate was 2% or higher to trim us down from 40 to about 23. And we can do the same thing on here. It was a 5-year share buyback rate. And so if we set that to a minimum of 2%, we've got the same list here. We're down to 22 stocks. All right, so we're already trimming our list. Went from 68 to 22 with a couple of just really basic scans. And, I could give you 20 things to filter for, but you won't have any stocks when you're left. So you got to just, look at what's most important to you. And then finally, for a valuation filter, I just scanned it by enterprise value over EBITDA. And what this is, it's kind of like a PE ratio, only I think it's a little bit it's a little bit more accurate. A lot of the value guys use it because instead of market cap or the total value of the company, enterprise value includes debt. Okay, so if the company has a market cap or the cost to buy it is say $1 billion, but they've also got $500 million in long-term debt, then if you were to buy that company out, what are you really paying? You're paying $1.5 billion, right? Because you just assume that big debt with it. So they take enterprise value, that's the EV, and then EBITDA is earnings before interest, taxes, depreciation, and amortization. Essentially gross profit. And it's a little bit smoother. If you look at a chart of EBITDA, you'll see it kind of like this. And you could see a net income chart that looks kind of like this. Because maybe they spent a bunch on advertising one year. Maybe they had some small change. But EBITDA is a bigger number. It's smoother to give you kind of a cleaner picture there. So it's a nice quick way to just find the 10 most undervalued out of that group. And we could do the same thing on our screener. Let's see, valuation ratio, EV to EBITDA. Let's see, actually we just want to filter by this. Let's see, so we're looking at 9 and less. We'll just set this to a max of like 9. Gives us 11. That's about the same. So that's another way. Just give us our to trim down that list. I'm just showing you visually in Excel. Okay, so not a lot to it, right? But what do we have now? We've got a concentrated basket of stocks that have not lost money in the last 10 years, so we know they're very consistent, right? They're buying back shares and have been, at least they're gobbling up 2% of the company every year at least, which is concentrating our value. They're not little tiny companies. It's set at 500 million. I think it's actually, you could actually do it to $1 billion and get the same list. Yeah, so $1 billion or higher. So they're not micro cap. They're not little mom and pop shops. We've got a valuation scan on this to find the ones out of our list that are the least overvalued, just based on value metrics. All of these stocks are yielding 1.9% or better today. They're using less than 60% of their net income to do so. They've been growing their dividends at least 10% a year. So our paychecks grow at least 10% a year. And they've been doing so for at least 10 years. Okay, so this is a really high quality list of stocks that I would be more than comfortable owning. And you notice we just filtered by 2 stars or higher, but once we put all these valuation metrics, now we've pretty much got 3-star and above companies, because it's just the higher quality companies tend to be the ones that pay these healthier dividends and continue to raise them on a more regular basis. Okay, so that's one way to do it. Another way to do it, and this is taking the same raw data we had before, what I did is break it down by sector. And it's the same data we had in that chart. I just kind of highlighted it for you guys. You could see the different sectors. A lot of people, when putting together a basket of dividend stocks, want to diversify to various areas of the market. Okay, they don't want to be too tech heavy. They don't want to be too, bank heavy, because if there's a real downturn in that sector, you're going to get hit pretty hard, right? I mean, if you were really heavy on financial services stocks in 2009, I mean, you're doing fine today, but you had a few sleepless nights. So you can do this on a sector-by-sector basis as well, and this is kind of what that would look like. Once again, filtered by the share buyback rate, and just kept the top 3 or 4 in each group. Okay, so I'm not looking at them as a whole. I'm looking at them by each sector to be sure we maintain some stocks in each sector. After that, did the same thing, enterprise value over EBITDA, and filtered it down a little bit further. Just took out the ones, the highest numbers here for EV over EBITDA, and then kind of put together this final list of 10. Now, I have a little bit of personal input in this one to give you a few examples. What I did, consumer cyclical, like it's we're at the high end of a business cycle, so I don't want to be too heavy on cyclical stocks right now. These are the stocks that do really well coming out of a depression or out of an economic downturn, and they do very poorly going into one. So I want to be light cyclicals. They're up a couple 100% since 2009, but comfortable owning a couple of consumer defensive stocks, right? Target, Walmart, big staples that aren't going anywhere. I didn't really need any more than one energy stock. I didn't want to overweight it there. Energy being commodity based just has a tendency to fluctuate. I'm not crazy on financials, so I picked just the one that had the strongest fundamentals based on those scans we did. Healthcare has also had a huge run recently. There's a lot of government regulation involved in these companies and how that affects the bottom line profits. I don't want to be overexposed on healthcare. Just held the one strongest one here, and then a couple of industrials and a couple of tech stocks. Ones I feel more comfortable with. So we got Norfolk Southern, CSX, Harris, Texas Instruments. And look at the metrics on these companies. Like here are 10 down here. Here's this 10 stock portfolio, and we just got top marks on pretty much everything. All these have been growing dividends. Look at that, anywhere from 10 to 30% a year for the last 5 years. Extremely low payout ratios. Texas Instruments on the high side. The rest of these are in the 20s, 30s, 40%. All have really high financial strength, 6.5 or better. All fairly predictable companies, 2, 3, 4 stars. The other things I like, all have pretty high share buyback rates. Gaps up at 10%. And then look at these earnings yields. I mean, this is something you're not finding in the Dow 30. You're not finding as an average for the S&P 500. Right now, you're seeing average yields of 4 or 5%. Just looking at what they're earning because of where prices are. And from our list, because we filtered it to the most reasonably priced, we're getting at today's prices earnings yields anywhere from 5 to 15%. Okay, so really high quality list. If you want to do a basket of 20 or 5 or 30, however you want to do it, you can filter it accordingly. But just kind of want to take you through a process and show you it's really not very hard, and you don't have to dig through the fundamentals of each of these stocks. Basically, the less homework you want to do, just buy a few more companies. Okay, if you don't really feel comfortable going through financial statements and really digging through, I mean, this will get you some pretty high quality companies. Maybe bump it up to 20 or so if you don't want to dig through each of these. And I want to show you the performance as well. Now, obviously, this is kind of tough because we're looking at where they stand today and then judging the performance. But I just thought it would serve to be an example, and I kind of went through all the numbers, found how much they paid out in dividends, what you would have collected, what the price performance has done of this basket of 10 stocks. All right, just to kind of give you a picture of what that looks like. And the top here is the 5-year performance. This is since May 2009. And we show everything here. How much you would have returned in dividends, how much the price has improved of the stock, what you made on stock performance, what you made on dividends, and then your total return here of 117%. And you're looking at this thinking, we did all that work and I beat the S&P by 5%. Because that includes dividends for the S&P as well. But here's what you want to think about. I mean, could you really pick a better 5-year period to be holding stocks from early 2009 to this peak here in 2014? No, so it's a little bit, I mean, overall, this type of investing is going to beat the market by a much wider margin. But, we've just had a really, really strong bull market here. So to offset that, when we look at the 10-year performance, you get a much bigger picture because 10 years is really kind of a full business cycle. And here's what we're seeing. The S&P over the last 10 years, so from May of 2004, including dividends, has returned about 93.48%. So I don't know if that works out there, 7% a year, something like that compounded. And we've essentially doubled that. We've doubled that return with the stocks we're holding here, with this 10 stock portfolio. And the other, I should have put it on here, the other thing that's going to start to impress you as you have a dividend portfolio is, let me see if I can find them all. Here we go. Here we go. So these are our yields on these stocks based on today's prices. Now, had we bought these in 2004, beginning of this 10-year period, we'd be looking at much higher yields. We can go ahead and figure these out really quickly if you want, to kind of give you an idea. But it's what they were when they refer to yield on cost. This is what they're talking about. So, the things paying $1 a share or so. Based on a $40 share price, yeah, that's 2.5%. But based on your $20 share price, it's 4.5 or 5%. So that's the idea, is that you get to a point where, yes, you originally invested, say, $50,000, but now you're getting 15, 20, 25% yields on that just go up and up and up every year. So let's see. I have to ask Charlie to give me a formula here to show these yields. Charlie, can you formulate this? Okay, sorry about that. I got our resident genius here to figure this out for me. So this is going to show you what your yields are today on cost. All right, does everyone understand yield on cost? Let me format this down for us. Nah, that's not right. Moves the decimal. I don't know why it does that. So this is what we're getting. This is what our yields would be based on what we paid for these 10 years ago. So, you know, we can get an average here. We're getting about a 6% yield on our portfolio, whereas everyone else who's buying today is getting about 2%. And it's going to grow and compound going forward. So in another, I mean, our yield is essentially tripled. 10 years from now, maybe we're getting 18%. Other 10 years, we're getting 30 and 40 and 50%. So all of a sudden, you just got these huge paychecks. And you take those dividends, you roll it, you put it back into more shares and more shares, and you're essentially building up this funnel. And then as soon as you pop that cork and tap that funnel of cash flow, you just got a stream of paychecks coming in. Okay, so it's really, really powerful when you see what this stuff can do over the long term. But the biggest thing here, I mean, you know, don't judge us by the 5-year performance. It's the best 5 years of S&P stocks, probably of our lifetime. But we look at a bigger picture, and this is just 10 years. If we went out 20 years, I'm sure it'd be even more severe of a beat. But you know, 190% versus 93 is really, really strong. And that's just using some really basic stuff, high quality companies, consistent growing dividends to benefit our long-term portfolio. So what questions do you have about this, and what do you guys want to go back over? And Emmanuel's got a good question. He said, does this take into account reinvestment of the dividend? It is not. No. I mean, I'm just using a basic. The S&P does. I'm just looking at the total as if you did not reinvest this money. So this is just cash you took and added it onto the stock performance. But it's actually, yeah, even higher if you reinvest that money and took part in some of the stock performance as well. Greatest engine of growth is compound interest. Absolutely. Joseph, can you show the formula for yield on cost? Oh, yeah. Our yield on cost formula, all I did was take the yield and then multiply it by today's price over the May 2004 price. And there's a formula for yield on cost on the website. Now, this one's a little bit different, so I appreciate you bringing this up. When you look at a stock on here, it's going to show you, let me find a more consistent grower here. Let's look at like Walmart. But on the dividend tab, it gives you a 5-year yield on cost figure. Okay, now this is just a ballpark, because what this is saying is, okay, well, assuming they're yielding 2.3% today, they've been growing their dividend about 14.5% each year. If they continue to do that for another 5 years, this will be your yield in 5 years on today's cost. Now, the one we just calculated in this Excel spreadsheet, since we're looking at 10-year performances, this would be our yield on cost if we had bought these stocks in May 2004. Okay, does that make sense? But yeah, very good question. Yeah, I mean the dividend tab is really cool here. It's laid everything out really nicely for you. It tells you okay how high is the payout ratio, are they buying back shares, and you can even look at this is so cool. And you can just do this manually if you want to go back to say 10 years ago, or goodness if you want to go 20 years ago. Um, and then it'll automatically calculate your annualized growth rate, so your cost on compounded annual growth rate. So it includes both the amount of dividends you've received as well as the growth from the stock. So 20 years ago, you'd already have paid yourself back with dividends, and now you're looking at a yield on cost of, oh goodness, let's see, $12 a share you bought in at, and today they're paying $1.92 a share. So I mean, you're up there at almost a 20% dividend yield on cost. Where do you find the earlier prices? Example, May 2004. Marion, you can do a couple of things. I actually went through and found them manually, like pulling up charts and just finding the price, the closing price, the first week of May in that year. You can also scroll down here if you want to look at the annual numbers. And I believe quarterly might be built in here as well. Here on the 10-year financials, if you're a premium subscriber and you scroll down to the bottom, it's got a history of this. Down here under valuation and quality, and the third line item down there is month in stock price, and this will show you what that price has been for the last several years. Now if you want to do a giant data dump and download this using this button down here, it will give you all that price data for as long as we have it, so probably 20 or 25 years for something like a Walmart. Yeah, we were looking at that. Yeah, we just did that. Yeah. Charlie's got me show you guys the total return calculator. We just covered that. Craig, can you account for consistency in dividend growth, i.e., no drops in dividend over time? That's a good question. I don't think we can. We have a list of stocks. I think he calls them dividend acrobats. Let's see, it's in one of your predefined screens here. I think. There they are. S&P 500 Dividend Aristocrats. And this is, let's see. Charlie, how are these found? For 10 years? Oh, wow. Okay, so this is Charlie's list he's put together for you guys. This is the list of companies that have increased their dividend each and every year for the last 25 years. So if you want a quick basket of 20 stocks that are the kings of dividend land, this is them. So just go to your screener. Under the GuruFocus screens, one we provide for you is S&P 500 Dividend Aristocrats, and he's got the stocks manually put in here. I mean, there's not a formula built in to scan for that. He's done that on his own and put the tickers in there for you. Herman asks, since the price fluctuates, do we still follow these, for example, like a Peter Lynch chart, to find the best time to buy into it, or just buy them and don't worry about the stock price? So, Herman, good question. Really good question. In general, with dividends, you care less about the stock price, but what you're going to see the fluctuations in price, similar to like a Peter Lynch chart, through that yield. Okay, so if you get, like for instance, these 21 stocks right here are the absolute best of the best. And so for these, I may just want to filter for the highest yields right now to see the ones that are maybe in a dip, and that's being reflected through a higher yield. So we got Con Edison, HCP, AT&T, Chevron, Clorox, etc. on down the list. But for the most part, no. I mean, as long as they have a dividend yield, at least what the market's doing, I wouldn't worry too much with it. I mean, it's kind of one of those set it and forget it type formulas. Scott, I guess you would not buy these 10 stocks right away. You'd want the price versus intrinsic value to be favorable, right? I mean, yeah, in an ideal market, but we can't always time it. I mean, look, I'm in a school that I think the market's a bit overvalued. I'm not crazy about a lot of these prices, but if I'm looking at 10, 20, 30 years down the road, I mean, what's really the difference? As a dividend investor, if the stock price falls 20% next year, that doesn't mean the dividend's going to fall 20% next year. So I'm continuing that. It'd be nice to get the growth with it, but you don't, as a dividend investor, you don't have to try to time it as hard as just looking for price appreciation gains. Ananda, do you consider a specific strategy in a situation when the market in general is overvalued? Yeah, Anita, I mean, that's a really tough question because it's easy to say, oh yeah, we're overvalued, go to bonds, do this and that, but there's no limits to it. I mean, I think it's a little bit overvalued, but there's nothing that says this market can't keep running for a couple more years, and Charlie actually thinks it will because of the looseness of the money flow right now. I just try to maintain a focus on value regardless. Just become kind of like a hawk, and you don't have to invest any different when it's 2009 versus when it's 2013. I mean, you'll just see in 2009 when you run a scan for the type of stocks you want, you get a list of 80 candidates, and when you do it in 2014, you get a list of 6 candidates, just because the valuations have changed. So as long as you maintain that same investment philosophy and keep looking for the same things and just refuse to pay inordinate prices, I mean, I'm not going to buy an Amazon at this level. I'm not going to buy Tesla with no earnings, and I'm not going to pay 500 times earnings for a Yelp, or I can't get behind an $18 billion purchase of Snapchat. Just stick to your plan, and what we've seen the last couple of months is a big sector rotation taking place. And I wrote an article on this, but if we look at let me see if I can find this on the site. If we look at sector performance, and let me see if it's in the Schiller by sectors. But you'll see that we're just getting, if you look at the big losers and the big gainers recently, value's been pushing higher, whereas the really high PE stuff's been getting hit hard, right? You're seeing Amazons and Teslas and a lot of these ISIS and the really high flyers of last year taking some hits, whereas the deeper value things are beginning to push higher. So we've seen an S&P that stayed about the same level, just a shift of the money. So it's going out of the hope and dream tech type companies and going back into the value and the fundamentals. Scott, international markets. Yeah, I mean, the different markets are valued differently. I'd encourage you just to, if you get global membership, which you can add on for any region you want, you can run these screeners to any place on the globe, really. So I can just check boxes and pick up stocks in Canada, or UK, or Europe, or wherever you want. A lot of these our gurus are beginning to invest more overseas and finding more value over there relative to the U.S. markets. Anita, do you consider PE ratio? So I didn't consider PE ratio in this. What I was really looking at is just a total value. What are you paying for it? So I used that enterprise value over EBITDA screen to do kind of our value filter, and that's this right here. We just set that to a max of 9. You set it to a max of 10. I mean, generally just the lower the better. With something like that. And if you decide to use PE instead, you can. If you want to use PEG instead, you can. It's really up to you. Just use some kind of component, something from this valuation ratio tab that will allow you to filter it down to the ones offering the best value to you, right? I mean, you can't say, I'm only going to pay 5 times earnings. Well, you're not going to buy any stocks because there are no stocks trading at 5 times earnings that have consistent dividend yield. You're just not going to find it. So, you just want to find the best of the best in today's market. Marion, can you run a filter as of a previous date, 5 years ago, and walk it forward? We can't run filter for where they were 5 years ago. We can only run for where they are now. Now we can put together a list based on today's prices and go through it again. We can't really put one together based on where fundamentals were 5 years ago. We'd have to upload all the old data into the database it's searching for, and instead this screener uses the most recent possible data. Scott, I mean, I can't tell you where the best place to invest is. No, I mean, I will tell you from a valuation standpoint, Europe comes in a little bit lower than the U.S. Yes, I mean, on paper, black and white, they're a little bit cheaper. I know Asian bank stocks are generally a lot cheaper than U.S. bank stocks right now. Yeah. Now, when you go to the all-in-one screener, there's actually one. Charlie did a write-up. If we reset this, there's a couple of like these laid out for you, which kind of walks you through step by step these filters over here on the left side. And one of them is a screen for high dividend stocks. So if you want a bit of a walkthrough here, just click that link. It's a nice write-up he did, showing what kind of yield you want, what kind of growth rate you want, the dividend payout ratio, and just kind of steps you through that process, kind of like we've done tonight. Going to help you in beginning that process and running your own screens. Any other questions about it? Good questions, keep them coming. I promise if you have it, someone else has it too. I mean, the biggest thing, there's no perfect formula, right? I mean, you want to find the biggest things you want. Be sure you got, 5 or 10 years of dividends. Be sure your payout ratio is not abnormally high. Be sure your yield is, I don't know what I mean, at least 2% or something, something there on the low end. Be sure they're growing dividends, or else it's no one gets excited about walking on with 2% yield, right? I mean, no one gets excited about a 2% yield. We're buying these because we want the dividend to be more and more and more and more as the company grows. We want to be rewarded for that. We want eventually to be getting 20, 30, 40% returns on what we invest today. I encourage you to do something on the valuation ratio. If you're a PE person, you want to look for PE less than 15 or less than 20, you can do that. If you want to, find more growth type stocks, you're going to try to find a peg less than 1. I don't know if we'll find any. Yeah, there's 14 of them in here. I like it just at a ballpark, enterprise value over EBITDA, keep that to a low number. However you want to do it, just do something to maintain that value outlook and shrink this list down to valuable opportunities. And then, generally you're not going to find a lot of these really tiny companies paying any dividend whatsoever. You're not going to find a lot of growth companies paying dividends, so this isn't a big importance. But, be sure it's a large, stable company that doesn't have any huge risks it's facing. And then just use a little bit of common sense with it. Yeah, Craig's mentioned, he said in Charlie's write-up he mentioned scanning for 3%, and he did. I believe when he wrote that article, that was about the average of the S&P. Let's see, this was 1 year ago, pretty much to the day 1 year ago. So yeah, the yield was just a little bit higher at that point. But if you want to search to 3, absolutely. I mean, I was just trying to get a bigger list there. And then the other thing, just a little bit of common sense with it. I mean, I think I trimmed out some of the stocks I trimmed out were just personal preference. Because what did I take out? Like I took out IBM. I'm not sure about them as an innovator in that market, so I took it out. I'm not crazy about them. I took out Family Dollar. They've had a big surge in price. I'm a lot more comfortable with Target and Walmart versus the Family Dollar. They're just really behind the curve. I mean, it's a staple cheap thing that a company that's going to perform well generally in a bad recession, but they're not an innovator. I mean, they're not keeping up, and they could very much well disappear. I took this air products and chemicals out just because it's the only one of the basic materials group, but its metrics were just awful. I mean, really low predictability. The EV over EBITDA was extremely high. The buyback rate was almost non-existent. The earnings yield was the lowest of the group, so I cut that one out. So just use a little bit of your own personal preference and common sense, and put together a list that makes sense to you. Pock, what do you think of the dog of the Dow approach? Pock, the dog of the Dow is what it is. It's a very basic formula, guys. When they take the Dow 30 stocks and they take the worst performers end of each year and just invest in those, thinking that what goes down must come up. I'm not really crazy about it. Stocks get delisted from the Dow all the time. I mean, if the best value stocks there happen to be the dogs of the Dow, so be it. But the markets are becoming more and more efficient every day, and if they're discounting a stock, pretty severely, it could be the future prospects look terrible, and it's going to continue to shrink. I need IBM. I mean, look, don't let me tell you what to do on IBM. I mean, I think Buffett owns the thing, and he's a far more brilliant man than I. I just, I don't really see it there. I mean, I looked at, when you've got Googles and Apples and these other companies innovated to the level they are, I don't see IBM keeping up with it. I mean, we're seeing the desktop PC market slowly decline to tablets and mobile, and I just don't see IBM having a really big presence in the space it's going. So I try to stay a little bit ahead of things, and that's why it's just not a favorite of mine. It's trading at a good price. It's a fairly valued. It's just not one I'd put in my portfolio. Maybe you feel differently, you'd put it in yours. Susan says they're moving toward a service company away from a hardware company. Okay, so yeah, I mean, if you're more familiar with the company, you might have a better idea. I'm in no way an expert on IBM. It's just one I chose to cut from the portfolio. All right, we have any other questions? If you guys are not premium members, pretty much everything I've shown you tonight is premium features. And Charlie spent 10 years building this site. It's a wonderful resource for personal investors. The all-in-one screener is definitely a premium feature. If you're not a member or not sure, take a trial. It's 7 days. You can call and cancel, no questions asked. You can cancel it online without even talking to us. You can email us. But just give us a chance. Try it for 7 days. Put it through the paces. Play with the tools. You can entertain yourself for months with this thing. It's just tons and tons of fundamental data and just top caliber research for any value-based investor managing their own money. And so I'd encourage you to give it a shot. And see what you think. If you decide to stay with it, it's $2.99 a year, and you can cancel anytime. It's also prorated. Now, there will be a recording of the webinar, as I mentioned before. If you go to the homepage, let me show you where this is for future reference. When you go to the GuruFocus homepage, you can see last week's replay right here. Each week, you'll see the upcoming webinar right here. And if you click that, it'll take you to the registration page. And then I also put the week before's replay right there below it. So if you just click this link, it will pop out and you can watch. This is last week's topic. You can even blow it up full screen if you choose, okay?
So tonight's webinar is entitled How Peter Lynch Earned 29% a Year for 13 years.
Now, if you want to find the archive of them, just hover over the Home tab up here in the top left of your screen. This is for free members as well. Just hover over this Home tab, and you're going to click on Tutorials. And right there, Charlie puts these in here every Tuesday morning. Down the right side, you'll see all the replays of the webinars we've done. So there's the Peter Lynch we did last week. We did Walter Schloss before that. Had a value stock. This one's really good. If you guys are new to trying to put a price on a stock, we went through all the big valuation methods and how to use those and how to use the site to get them. Went in depth on scanning back in here. So these are all archived for your convenience. You can go back and check these out. And they're all linked up on YouTube, so if you can find our YouTube channel, you can get them that way as well. Yes, Grove, they're available for free members as well. Absolutely. Grove, the newsletters come out the first of the month, so I know the Ben Graham net pick came out over the weekend. I haven't seen Buffett and Munger, but generally those are first of the month issues that are sent out. Those are free for members as well. We also have a Peter Lynch newsletter if you like growth stocks. It's a premium service, but it's only $100 a year. You can find information on that about that on the homepage as well. And Scott, next week's subject has not yet been decided, so if you guys have a topic you really like covered, I'll be glad to do our best to do that for you. Feel free to send me an email. My email is ross@gurufocus.com. We're considered support at gurufocus.com. Let us know what you think of the webinars, what you'd like changed, what you'd like to have covered, and we'll be glad to do all we can to make that happen for you. All right, well, there's no further questions. We'll go ahead and wrap it up and let you guys out a few minutes early tonight. We appreciate you being here with us, and there's a lot you could have done this Monday evening. We thank you for spending some time with GuruFocus. If you have suggestions for the website or questions, please feel free to call and email us anytime, support@gurufocus.com. And we appreciate those of you who are premium members and also the free members. We hope that you will decide to become a premium member. We look forward to working with you guys in the future. Y'all have a wonderful evening, and we will see you next Monday night.